In the past 4 years, the island of Puerto Rico has quietly become a center for cryptocurrency. Billionaires and other digital asset holders for one reason, tax. A U.S. territory, the island has made a play for a piece of the tax haven pie since 2012, when it passed 2 laws that resulted in a drastic reduction in rates. The transformation caught the eyes of cryptocurrency holders in 2018. After Bitcoin's first dramatic rally made many early buyers very rich. Former child actor and the co-inventor of cryptocurrency Tether, Brock Pierce, was one of the first big names who chose the low-tax island as his new home. Since then many others have made the same move, for the same reasons. In the U.S., capital gains tax on cryptocurrencies can be as high as 37%, but long-term holders can avoid tax altogether on digital assets on the Caribbean island. Far away from Puerto Rico, British advisors say they are also encountering a small but growing cohort of people interested in moving country for crypto tax reasons. Chris Etherington, tax partner at RSM, an accountancy firm, says he has noticed more inquiries from younger clients, quite happy to move overseas to crystallize their coin, in low-tax jurisdictions such as the United Arab Emirates. While emigration might seem extreme, these actions illustrate the keen interest many investors have in minimizing tax in this fast-evolving new asset class. Revenue and Customs says bluntly that it considers crypto assets a type of property like stocks and shares, gold or impressionist paintings. So tax, specifically capital gains tax, can be levied on gains made. The U.S. Internal Revenue Service takes the same stance, as do tax offices in many other developed countries. These authorities are fighting hard to ensure the right amounts of tax are paid, including by demanding data from crypto exchanges about their users. But several bones of contention remain. Tax practitioners say rules designed for the pre-internet era are hard to apply in the digital age. They argue that regulations designed for assets that are clearly located in one jurisdiction or another are not easily adapted to a decentralized asset class whose backers often claim it has no home jurisdiction at all, indeed no home. In the UK, experts add, there is a lack of certainty around the tax treatment of crypto assets as there is no specific crypto tax law. HMRC has set out guidance on taxing cryptocurrencies. But this is not legislation and is in any case being contested by some tax professionals, including the Society of Trust and Estate Practitioners, STEP. It's just an awkward situation for the taxpayer because the revenue or shoehorning new technology into tax legislation that's been around for a very long time, says Tom Wallace, Director of Tax Investigations at consultancy WTT and a former tax inspector. CGT law has been around since the 1960s when crypto would have been something you would have seen on Star Trek. Fort Money takes a look at this complex and sometimes obscure landscape and tries to find a way through its rapidly changing features. Please use the sharing tools found via the share button at the top or side of articles. Copying articles to share with others is a breach of ft.com T&Cs and copyright policy. Email licensing at ft.com to buy additional rights. Subscribers may share up to 10 or 20 articles per month using the gift article service. More information can be found at https://www.ft.com/tour. https://www.ft.com/933489144-24C2-46551-9C-D-594085556C44 a new front in an old battle over tax. The U.S. tax authorities are widely considered to be the most aggressive in their efforts to make sure investors pay tax due on crypto. The IRS successfully issued legal summonses, known as a John Doe summons, used when a person's name is unknown, to obtain investor information from crypto exchanges Coinbase, Kraken, and Poloniex. This data has been used to check information submitted to the IRS by hundreds of thousands of crypto investors, and to identify discrepancies. It has been very successful at getting people to come forward and do an amended tax return, says Sean Hunley, tax consultant at Thomson Reuters Tax and Accounting, based in Atlanta. In May, the IRS announced it had set up a specialist team to analyze blockchain, the technology used to power cryptocurrencies, with the aim of tackling tax evasion. The mission is called Operation Hidden Treasure. Meanwhile, under President Biden's $1 trillion infrastructure bill, plans are afoot to make it the law for crypto brokers to report their customers' gains directly to the IRS. The bill, which has drawn howls of protest from the crypto industry, will make it easier for the IRS to gather information than through the courts. What we're going to see in this area is forced compliance, which is quite different than the current system of voluntarily reporting crypto gains, says Hunley. Critics argue the bill's definition of what constitutes a broker is too wide and could harm the emerging sector. But despite furious lobbying, it looks set to go through. In the UK, HMRC has used its information gathering powers to demand lists of crypto investors from exchanges over the past couple of years. Please use the sharing tools found via the share button at the top or side of articles. Copying articles to share with others is a breach of ft.com T&Cs and copyright policy. Email licensing at ft.com to buy additional rights. Subscribers may share up to 10 or 20 articles per month using the gift article service. More information can be found at https://www.ft.com/tour https://www.ft.com/933489144-24C2-46551-9C-D594085556C44 under HMRC guidance. The disposal of a digital asset triggers a CGT claim. Peel says this applies even if holders switch from one coin to another, even if it is into stablecoins, special stabilized digital coins linking fiat currencies and volatile crypto units such as Bitcoin. More recently, owners have been able to lend, or stake, their digital coins and earn a yield, an activity that could potentially create new liabilities, Peel adds. Another potential problem for investors is that they may crystallize a gain and CGT liability but find that by the time they have to pay the tax their portfolio has fallen in value and so not be worth enough to cover the liability. You can't pay your tax bill in cryptocurrency, so you'd have to sell other assets including crypto, which itself could trigger a tax charge as if you exchange it for cash. That would count as a disposal, says Salabank. But despite the difficulties, there is every incentive for investors, crypto operators and tax officials to all keep on top of their game. With the crypto market now estimated at nearly $2 trillion, the potential gains, and the associated tax liabilities are simply too big to ignore.